recording. All right, let's get started. Welcome everyone. This is our webinar number 27th. It's almost close to 6 months now that we've been meeting here and talking about what are the options available to us as a retail investor. So we look at a normal equity market, and then for past few weeks we also started looking at the decentralized or dark or crypto markets. Again, all from education perspective. It's always good to be aware of what's happening in and around our world before the changes hit us, so that we are prepared. So a lot of stuff that we have to cover today. A quick disclaimer, everything that we do here is only for education, not an investment or financial or tax advice. Talk to your professional, talk to your CPA, talk to your financial advisor if you want to make any transaction based on what you hear. So I'm not your professional advisor here. We are here to learn from each other. So things we're gonna cover today, we'll also I'll give a quick update on what I'm hearing on the crypto world. We'll continue our discussion on decentralized finance. We'll do a quick market recap, some of the news that I saw in market. Then I also, uh, you know, studied a benchmark. Benchmark Capital is a very well respected venture capitalist firm. Every year they produce a report on their cloud 100 disruptors. So I went through the report and I'll give you a quick summary of those. What is benchmark seeing in this world? Most of the companies are private, but now we know how to invest in private companies. We had a session in that. So now we can talk about what are some of those companies that benchmark is seeing. Then we'll get into a case study for option trades. We'll also look at the trades that we've been talking for weeks and see where we are on that. And lastly, I'll cover what's on my watch, what I'm looking in the markets for next week, and we'll open it for general Q&A. So that's the agenda for today. We got a jam-packed agenda as always, and it's fun. And I thank you for spending time here. We learned a lot of stuff during this couple of hours. So before I jump into it, anyone had any questions? Anyone joining here for the first time and wondering why are we doing this, etc.? So paste your question in the chat box, and I will monitor the chat as we go along. And then in the end, we'll open it up we'll have a kind of open house. If you have questions, raise your hand and I'll unmute you and then we can go through it. All right, so let's start with crypto world. What I noticed, some of the things on the crypto world, and then we will continue our learning from this world. So till now, we have talked about blockchain, the core technology behind all the things that we hear about, cryptocurrency, smart contracts, etc. We also looked at the first application, which is currency. And from a retail investors, I think that's the only thing, if most of the people know about the decentralized world, is Bitcoin. But as we have seen, there are a lot more things to it than just a Bitcoin as an application. So we started with a Bitcoin or a cryptocurrency as one application. We also looked into smart contracts, how the smart contracts have a potential to change the world, how we can build our investment thesis based on smart contracts. Then we looked at what's happening from adoption, why this has not become mainstream, and what's the work happening behind the scenes to make this mainstream. And in our fourth session, which is last week, we started talking about decentralized finance. So the application of this wonderful, wonderful blockchain technology is moving way beyond just as a currency, which was the first use, to why not use it into our everyday finance? There are so much of applications that could be derived and could be simplified using this blockchain technology. So we looked into that. And then today we will continue our discussion on decentralized finance. Like I had mentioned, we cannot finish all of that in one session. So we will talk about it in our part 2 today. A quick news, a few things that caught my eyes. FCA, Financial Conduct Authority of UK, they have banned the sale of the derivatives on crypto assets. We saw similar action from US authorities. We talked about it last week, where in Department of Justice and CFTC, they uh, basically banned an exchange called BitMEX because they were selling derivatives without being registered as a futures exchange. Similar action we see in UK. So the UK regulator says that it considers these products to be ill-suited for retail consumers. I don't blame them. I don't blame financial regulator for saying this, but let's look into why they are saying it. And that got, chuckle out of me. First reason, inherent nature of the underlying assets, which means they have no reliable basis for valuation. What's the reliable basis of valuation for gold? Anyone? Gold doesn't produce anything. Gold doesn't generate anything. Its basis of valuation is what you, me, what the people who are holding gold give the valuation. If we think it's a store of value, it is store of value, right? But we are comfortable with gold. No one is banning trading futures, gold futures, right? So these crypto assets are not there yet. Prevalence and of market abuse and financial crime in secondary market. True. There are crimes being conducted. There are hacks being conducted. There are bad players in the market who are manipulating the market so that they can get money out of retail investors and fly, and just disappear. We see it in today's world also. Last week, JP Morgan was fined almost $900 million because they were doing the things which is like white collar robbery. So nothing new. This happens in every market. Third reason which FCA gave was extreme volatility in asset price movements. Let's talk about Nikola Motors, talk about Tesla. It's not that we have not seen these things before. But in crypto world, they're saying, oh, because of these reasons, we want to ban the sales of derivatives. But we see these things happen in today's, in the assets that we deal with every day. Inadequate understanding of crypto assets by retail consumers. Talk about all those traders who just pile onto the trades without understanding what that company is supposed to be doing, right? It's a blind leading a blind. People pile on to the trades. People see that there's a whole pump and dump schemes that we see going in the micro caps in equities. So nothing different in crypto. Also things happen. Lack of legitimate investment need for retail consumers to invest in these products. That is why FC wants to ban it. What's the legitimate need for investing in a micro caps? I don't see it. So the reason why I brought this up and kind of when I was looking into the reasons that FCA gave, I'm like, I see this happening every day. I see this happening on US exchanges. I see this happening on regulated exchanges, on regulated products. So that means it's just a matter of time when these things will just go away. People will, or the regulators will come around and say, so what? So that was one thing. It's not a good news for this world, but I don't see anything which is way out of what happens in the other assets even today. Just that there is not enough understanding of crypto assets. We don't have a full framework yet. So once that is built up, I think things will fall in place. Do let me know if you have any comments, etc. Other thing, and this is very interesting. Now, this is a second company that I noticed is replacing their company treasury reserves with Bitcoin. So, taking a step back, when a company has cash available on their balance sheet, they want to deploy that cash. Cash doesn't earn anything, so they want to deploy the cash, make sure it is generating something, or they hold something which is store of value and is and which can be utilized later. So most of the companies, they hold their cash into treasury bonds, the safest instrument which is available. Now we are seeing there's a second company. We got a news from Square that they bought a Bitcoin worth $50 million, which is right now only 1% of total assets. So they are using their cash and parking it into Bitcoin because Square believes that this is an instrument of economic empowerment and provides a way for world to participate in global monetary system. So Bitcoin is not only for to be used in darknet. It's not only for scammers or um, to be used for nefarious purposes. Square is buying Bitcoin. They do see that it could have a value in future. Now, why could this be a game changing? Buying a Bitcoin is okay. What Square also did, they published the whole rule book of how they went about the whole process of including Bitcoin as an asset on their balance sheet. It means all they're saying is, hey, the other CFOs, if you want to know how to go about it, here's the rule book. These are the steps that you need to do 1, 2, 3 to get on board, onto this Bitcoin train. So, which was interesting. And like I said, Square was a second company we saw a few weeks ago. MicroStrategy, they did the similar thing. Of course, this was at a much bigger scale. And somewhere in mid of August, MicroStrategy had bought Bitcoins. Then in September, they upped their stake. They bought another set. So right now, totally, MicroStrategy has got $425 million staked into Bitcoins on their balance sheet. Is it good? Bad? Is it too much? I don't know. It could be too much because what if Bitcoin is too volatile? But I think the board of directors and the CFOs and the C-suite executives on MicroStrategy are okay with holding so much. So this was I really when the news from MicroStrategy came out, I'm like, okay, I know their founder is little eccentric, so and the founder control a huge percentage of MicroStrategy shares. So if he wants to do something, he could. But when I saw the news of Square, I'm like, okay, now we're talking about a well-respected listed company taking the decision of using Bitcoin or of replacing some of their treasury holdings with Bitcoin, which is an interesting news. We still have to see how many other CFOs may follow the footsteps, but this is good. It was a good news. Uh, Third thing talk about was Ross says, didn't OSTK also has to do something with Bitcoin? So, but they have not replaced their treasury with Bitcoin. Ross, what Overstock does is it's got a two separate businesses. One is definitely overstock.com, which you and I, we know as a consumer, you go and do purchases on the web. That's their e-commerce business. The other side of Overstock is they have a subsidiary called Medici Ventures, And Medici Ventures is focused, it's like a venture capital firm which is focused on investing into companies which are active in, I would say, crypto assets space. So, for example, they are the backers of an exchange called T0. They have they have investment into multiple such companies that are active in this space. So that's how when you hear Overstock, that's where it comes into picture, because it's because of the through the Medici Ventures, which is a subsidiary of Overstock. Yeah, so Medici Ventures, they basically kind of a venture capitalist firm who is focused on to change the world by advancing blockchain technology. So that's a connection of Overstock with Bitcoin. I do recall, I think in 2017 or something, Overstock started accepting Bitcoin as a form of payment. I don't know if they still do, uh, but that's a connection of Overstock with Bitcoin. Okay. All right. Third thing, disruptors are being disrupted. So let's talk about, when we talk about some of these exchanges like Coinbase, Gemini, these are the exchanges where for trading crypto assets. Now, they call themselves as disruptors because they are enabling retail customers and making it easier for them, for retail customers, to buy or sell or to trade or to store these crypto assets. Right? So they call themselves disruptors. But in last 2 months, we have seen that those disruptors themselves are being disrupted. Why? Because of the decentralized finance craze that we see going along. So quick number. We talked about Uniswap, which is a DeFi exchange. The monthly volume of transactions in Uniswap was 15.3 billion, which surpassed Coinbase volume of 13.6 billion. So Coinbase is considered to be a torchbearer or the well-respected, regulated exchange for trading crypto assets. Now they themselves are being disrupted. There's a lot more trading happening on those decentralized exchanges than had happened on Coinbase. And then I heard that Coinbase is to catch up. Now Coinbase is started to include a lot more assets which are off the DeFi exchanges itself. So we will talk a little bit about it. I remember when Coinbase started, they were very particular on which assets would be allowed on their exchanges. They had a very strict criteria which they published, and they really stuck to it. So in, let's say in 2017, if you want to trade in this world, if you are on Coinbase, you had a limited choices. You could trade on Bitcoin, Ethereum, Litecoin, Bitcoin Cash, and Ethereum Classic. That's it. That's it. We don't have faith on other projects. Slowly and steadily, they started increasing it. And now I don't even know. I think they have a lot more coins. They also had Ripple at that time. But now they realize that if they don't step up their game, they will probably be completely disrupted, which we are already start to see. Anyway, so why this explosive growth happening? It is because of the growth of DeFi and yield farming of governance tokens. And that's the area which we're going to talk about is what the heck is this yield farming? What is happening in this world? So things are changing so fast. Things like Coinbase Gemini, which drove and got money from retail investors worth $13 billion, are themselves getting disrupted. So we'll dig deeper as a part of our study of decentralized finance. And today we will talk about what's all this yield farming. So before that, any questions? Let's get through those questions. I'll sip some water and we will continue to peek into the world of decentralized finance. All right, so let's talk about what's happening in the DeFi world. Then we will get back to our real world that we know as of now. Okay. Everyone now still able to see the deck? Cool. All right, so I'll quickly run through the recap because we've already gone through it last week, and then we'll directly jump on to the topic that we want to talk about today. We looked at DeFi last week. We talked about what exactly is DeFi and how the DeFi can become, can provide the services of banking, lending, wealth, asset management, capital market, insurance, everything. So we also talked about what's the opportunity, why this space is becoming so hot nowadays. What's the lure? Why people are getting attracted towards DeFi, and the monthly volumes of the trades that are happening on the decentralized trading platform. So as of September mid, it was almost $23 billion, which is nothing if we compare it with the amount of trading that happens on the exchanges like NASDAQ or NYSE, stuff like that. But all we're pointing out is the growth. It's been growing more than 100% month over month. We talked about it. The fact why it was growing because of tokenization, right? Tokenization of everything. We looked at even the Bitcoin itself can be tokenized. There are volatility tokens like in our real world, on the equity side, we have VIX. On the Bitcoin side, we have BWAL as a token. Then we also looked at how you can tokenize some expensive piece of art. And when I talked about this, I was just kidding because I put this art piece from my daughter. And then this week, I actually saw news that I think it was one of those sisters, maybe Paris Hilton. She actually sold a piece of art. It was a digital piece which was tokenized, and there was some money that she was able to sell it for a few $1,000s, and then that was donated to charity. So I was just kidding here. Looks like those things are becoming real. Then why only piece of art? Real estate can be tokenized, vintage car can be tokenized, and things like that. So then we also looked at why, as a retail investor, how can we participate? So we talked about these companies which exist in today's exchanges. These are all market making firms. These are one of the biggest market making firms in the world: Citadel, Virtue Financials, GTS. And they make tons of money because they provide liquidity in exchanges. We all are aware of those. We all are aware how liquidity is important for us to trade in markets. And then we left our discussion here, which is in decentralized exchanges, how you and I, we all can become a market maker. So we're going to talk about that today. In NASDAQ, I cannot become a market maker, even though I hold 5 million shares of OptionGig Pharma. Those shares are lying in my brokerage account, doing nothing. But if I want to provide a liquidity and become market maker on OG Pharma ticker, I cannot. But in decentralized exchange, we can become market maker. And that is what's been prompting a lot of this action in decentralized exchange. Quickly, let me know if anyone of you have actually participated or done anything in decentralized exchange. All disclaimer, I have not participated in it and not done anything in the decentralized exchange specifically. Even though I'm a little bit active on the crypto asset side, my mostly stuff is just to buy and hold some of the assets. I am not participating in any of these, but I want to understand, and I do read about it. It says not yet, didn't know about it. Oh, Ramesh, that's the reason why I want to talk about it, because most of the people, most of the retail investors don't know about it. And I would say be cautious if you want to play in this market. The reason is most of this could still be unregulated. We don't know who are the promoters of those exchanges. So I don't want to invest in that, or don't want to play. You have to be really on top of everything that's happening in this world. And this world changes quite fast. So I just want to be aware. That's why I'm just watching this market. So let's look at what's happening in this whole DeFi space, which is causing this craziness. So I want to introduce a term called liquidity pools. So what is a liquidity pool? So liquidity pool offers a new standard for efficiently trading assets while allowing investors to earn a yield on their holdings. Okay, a lot of mumbo jumbo. Let's break it down. So because you and I, we trade options, first thing we look into options is how liquid is the underlying. More liquid the underlying is, as a trader or investor, we get better pricing. We get a tighter bid-ask spread. It is easier to get in and get out of a trade. That's nothing new. That's something which you and I, we know, and we do look at any, before we put in a trade, we look at how liquid is it. We know it's easier to trade into Apple, but it will not be that easy if you want to trade into OptionGig Pharma, because Apple is very liquid. Bank of America, hugely liquid. SPX, SPY, great liquidity. So to enable efficient trading, make sure we have a lot more trading volume, it is essential that we have enough liquidity of a particular asset. In today's world, that liquidity is provided by market makers. That's their job. The only reason market maker exists is not to bet on whether market will go high or low. They are just to provide us liquidity. If I want to buy Apple share, market maker will sell it. They don't care whether Apple is going up or down. If I want to sell an Apple share, market makers will buy it from me. That's all they do. And because they provide this liquidity, they make money by the bid-ask spread. If you look into our option chain, or if you look into your stock price, you will see there is always a difference between bid and the ask. And that's essentially what market maker earns. They provide liquidity. They make money when anyone wants to buy or sell. The difference between the bid-ask spread is what they make money on. And those spreads in very liquid assets could be just a couple of cents, but they do it tens of millions of times per day. And that's why Citadel is, and the promoters are so rich. So what DeFi does, they obviously, for anyone to trade in decentralized exchange, you need to make sure that there is enough liquidity available of any asset that you want to trade. And I'm not recommending or suggesting a particular asset. I'm just talking about a basic concept is in any trading market, if you have a well and high liquidity on any asset, it is much better for efficient trading. So now in decentralized exchanges, if I hold, say, if I hold 500 or let's say even 10 Ethereum, like I told you, I'm a buy and hold investor on the crypto asset. But those 10 Ethereum are just sitting on my exchange. They don't pay any dividend. Only thing that I would earn on those holdings is if Ethereum goes up. Right? Otherwise, it is just sitting there. Now, on decentralized exchanges, I can use those 10 Ethereums and add it into a pool called liquidity pool. It means I am supplying liquidity to that exchange. So I could do it, you could do it, millions of other, I would say, customers or holders of assets can join together and provide liquidity to these exchanges. This is completely new standard. In the fiat world, when we talk about fiat world, means the world as we know today and we trade today in. There is nothing comparable that exists. Earlier, I was giving an example that I hold 5 million shares of OG Pharma. I still can't do anything about it. And OG Pharma is not very liquid on exchanges because market makers don't have enough liquidity. And here I have 5 million shares sitting in my account. I cannot supply liquidity in fiat world. But in decentralized exchange, if I have those crypto assets, I can become a kind of play a role of a market maker and can supply those assets. Okay. Now, when I supply those assets as an investor or a liquidity provider, I'll be paid for providing liquidity into that exchange. It is equivalent to I became market maker. Why Citadel gets paid? They provide liquidity. But if Citadel doesn't have a shares of OG Pharma and I have millions of shares of OG Pharma, I cannot give it or rent it out to Citadel and saying, take this and give me some, share of your profits. In decentralized exchanges, that's exactly what the liquidity pools is. That if a holder of an asset can put their assets, and if hundreds of thousands or millions of such people add 10, 15, 20, 100, that's what creates the whole liquidity pool. And those investors, they get paid. That's essentially is the liquidity pool. MMR like matchmaker, they and make money in return. Yep, they are matchmaker, but they don't hold any assets. All they do is they will buy it from you, and if you want to sell or if you want to buy it, they'll sell it to you because they have all those. They have availability of the shares, or if not availability, they know how to hedge it. So now for efficient trading, this is common. We know in the fiat world also, to control the asset price volatility on exchanges, the underlying asset should be very liquid. No surprises there. Same would be the case in decentralized exchanges. Liquidity will ensure that the participant traders get a fair market price. And a single transaction cannot manipulate the pricing. Nothing new here. Even in fiat world, if you're trading in micro caps, one big transaction comes in, it is not very liquid. The micro cap is not very liquid. Somebody bought 100,000 shares of that small company, OG Pharma, the price shoots up. Someone buys 100,000 of Apple, nothing happens because it's very liquid. So in a fiat world, the job is done by market makers. In crypto world, anyone can participate and become a market maker and can earn a yield through the process which is called automated market making, AMM. So now, if I am a decentralized exchange, and on my exchange, we are trading ABC and ETH as an asset, and I want to make sure I want to have enough liquidity so that you will come and trade on my exchange and not on Coinbase. What I need to do, I need to give you enough incentive so that if we are holding ABC assets, you come and stake in my decentralized exchange so that I can get the liquidity. So what happens? Investors can deposit or stake their crypto asset pair, thus increasing liquidity for those assets. So if I hold ABC and ETH, I can stake those in an exchange. And in return, I will earn a piece of trading fee that is generated by exchanges. Right? Only difference in the fiat world, there is no way for me to participate in it, even though I hold millions of shares of a company. But in DeFi world, it is possible. All right, so an example, if I open an exchange and I've got a liquidity pool of ETH and USDT, so you as an investor, if you have an Ethereum token, you can supply one Ethereum and USDT token. And if anyone else wants to buy this, I will be able to provide this as an exchange. They will be able to come and trade on my exchange. I will earn some trading fee. I'll pass on that earning fee to you because you have supplied liquidity. And it is very common practice to have a stable coin. We talked about stable coin. Earlier stable coin are the ones whose value don't change. It will always be $1. So if I am an investor in crypto assets, because these assets change a lot in their pricing, if I were to keep funds on an exchange, because I'm waiting for an opportunity to buy it if market goes down. But if I want to keep the fund, where do I keep it? I'll probably keep it in a stable coin because I don't want to keep in a token, let's say in a Bitcoin, and Bitcoin goes down, then the value which I had kept aside so that I can take advantage, and when market goes down and I can buy something, if Bitcoin goes down, that my stash loses in value. So instead what people do is they will invest in a stable coin because that will always have a value of $1. So irrespective of where the other coins are going. So in those cases, you will see a lot of these liquidity pools, which are, one Ethereum or one USDT or some other token with USDT or some other stable coin. I see some question. Who guarantees security of individual That's the software. So that's what I'm saying. It is a little risky in terms of you need to make sure that the exchange is well respected, has been audited, because in this world, the only guarantee is through the software and the smart contracts. There is no other guarantee. Even today, even on in the Bitcoin, there's no guarantee. The fact that I own a Bitcoin or you own a Bitcoin, it is only guaranteed by the entry on a blockchain. And if someone messes up with the entry on a blockchain, there's nothing much that you and I can do. But no one has been able to mess with that for whatever 10, 12 years. That's very secure. So the security or the guarantee is provided by cryptography and software. So now generally, whenever traders trade on these decentralized exchanges, you charge 0.02%. The exchanges charge as something as a gas fee, and that the fee get distributed to the providers of liquidity pool like you in proportion of your deposit to the overall pool. In fiat world, we get K1 at the end of a year. If we have invested in, let's say, uh, shares of some company, let's say Icon Enterprises, right? Those are limited partnership companies. If you bought shares in those companies, and if those companies make profit, you get shares, you get paid those profits in proportion of your holdings, which is 0.000001%, whatever. Right? Similarly, if on decentralized exchanges, you supply liquidity, I supply liquidity, Ron supplies liquidity, tons of thousands of other people supply liquidity. When the profits are distributed, a portion of profits, exchange also keeps some with them. Those will be distributed in proportion of the liquidity that's been provided by that individual. But in between, if we want to withdraw your earnings and we want to reclaim the assets, you want to take your liquidity out, you could take that. You said, okay, I don't, I earned a few dollars and I don't want to provide liquidity in your exchange anymore. Maybe I found something better. I found some better use of my Ethereum and USDT coin to use it somewhere else. Right now, because I staked or I given it to you, I have loaned it to you to provide a liquidity in your exchange. You can't do anything. But now say you found a better use of your assets and you want to take it out, you could. So there are many liquidity pools, those exist. These are all decentralized exchanges. We briefly talked about in last week's session, Uniswap, very famous. This is called Sushi Swap, and don't laugh. There are some crazy names like this. Curve, Balancer, all these are DeFi exchanges. And on those exchanges, you have a lot of liquidity pools, right? So let's look at some of the liquidity pools. Let's say top 10 liquidity pools. We got a Curve. We talked about this Curve here. So Curve has got DAI, USDC, all these are stable coins. Curve has got DAI, USDC, USDT pool. They got a BTC, WBTC. It generally happens in pair or multiple coins. There's Uniswap, USDT, USDC, WETH. So there, Sushi Swap. So there are, all these are called liquidity pools. So if I were to participate, say, in this liquidity pool, Sushi Swap, WETH, and USDT, it means I need to stake a, a tokenized Ethereum and USDT stablecoin in this pool. So let's look at Sushi Swap. Let's take an example. Staking No, I have not connected anything. I don't want to connect. Let me just figure out. I was able to see it, how to. No. Okay, maybe I'll look at some other um, curve. Hold on. Okay, so they do mention, for example, you have a die, you can pick which pair you want to provide liquidity into. So there are many liquidity pools that exist in this world. These are some of these, I would say, top liquidity pools. Let's look at some of the risks. There was a question, right? Who guarantees the security? It is security is guaranteed by smart contracts. Remember this, the whole idea behind this world is disintermediation. We don't want any lawyers in here. The smart contracts, the automated programs, and the cryptography that provide the security and the guarantee. Right now, if smart contract provides a security, what if there is a bug? It's at the end of the day, it's a software. There could be issues in the software. It may not have been audited. It may not have been well tested. It may not have been written by smart developers. Maybe I wrote that contract, though it's called smart contract. But if I were to write it, I will probably write a dumb contract. And there you go and you started staking your coins into my contract, and a smart hacker came along and could steal everything. And in some cases, the companies, they do get audited by the security companies, but still, Equifax got hacked. So it's someone smarter could still go ahead and hack the contract. And then they can steal away your staked assets. So that's a big risk, right? There is no authority you can go and pray to. So that is why it is risky. That's why I'm not playing in this. But there will be time when all those risks, etc., will be overcome. There will be some way or some governance that will be put across this whole process. That may be the time when we as a retail investors could start to participate. That's not to say that people are not participating in it. There's already, we saw $24 billion worth of exchanges happening on decentralized exchange. On Uniswap, there's a more volume happened on Uniswap than on Coinbase. So people are participating. Their risk tolerance is probably too high. Mine is not. So depending on what your risk tolerance is, you make a decision. So the bigger the liquidity pool, better is the experience for traders. No surprise, this is the same case in the fiat world also. So what could happen is that to incentivize the investors to stake assets in OptionGig, I need to do something different, because now you have options to stake your assets into Uniswap, into Curve, into Balancer, into SushiSwap, and I'm an up and coming decentralized exchange. I want to make sure that there are enough big market makers, or I have enough liquidity for the some of the well traded crypto assets. I need to attract you guys, but you guys, I've already staked my assets in Uniswap. I need to do something different if I were to do it. What I could do, I could give you a share in my company. Let's say, let's take an equivalent example in our fiat world. If NYSE has to attract market makers, and market makers has got tons of exchanges, let's assume right now they don't. But if market makers has got 20 exchanges in which they can participate in, NYSE has to do something different. In crypto world, what they could do is, hey, if you become a market maker in NYSE, you will have a share of NYSE. I'm willing to offer you a share of NYSE based on how much liquidity you bring to my exchange. If you bring in millions or billions worth of dollar, you will get more shares in my company. Similarly, in crypto world, if OGEX has to attract a liquidity providers, what they do, they give a vote in a governance. It means more profitable this exchange become, more valuable that share or that governance token will become. So now as an investor, not only you're earning money from the trading fee that OGEX generates, you get a portion of your fee like a K1. But if this exchange itself become profitable, the value of the token which or the share in OGEX also become profitable. And in crypto world, basically get a token which is equivalent of a share. So what some of these decentralized exchanges started to do is to issue those governance tokens. And over time, if this exchange become popular, hugely profitable, the value of these tokens increase. And then you can sell those tokens in the market. So you got paid for providing liquidity in with the fee, and you also got a token in this exchange, which if this exchange become profitable, more popular, you can go and sell in the market. So this essentially has led to a mad race among liquidity pools to provide governance tokens to investors. Because now I got a 10 exchanges and I got 2000 ETH and USDT. Where should I stake it? Everyone is giving me everyone is charging 0.02% as a trading fee. So that's a common thread. Why should I prefer one exchange over other? There are exchanges who are giving me something more. They are giving me some shares or a governance token. So now those liquidity providers, you and I, we started joining these liquidity pools, not to provide liquidity, but only for the purpose of getting these governance tokens. This practice is called yield farming. Now, from a liquidity provider, I became a farmer. The token value increases. I will sell that token. Let's say if I am staking my assets in OGEX exchange, while I'm earning the portion of a trading fee, I also got OGEX tokens, which has become popular. It has overtaken Uniswap in terms of how the number of transactions that are happening. The value of OGEX token also increases. I sell those tokens. I move out my assets to another exchange. And all this is happening in the race to generate more and more yield by rotating these assets from one pool to another. And this is what essentially is called yield farming. If you have heard the name yield farming, this is what it is. Now, there are multiple exchanges. Now, there is a company, or I would say a project, whose only purpose is to get your assets and deposit it in the liquidity provider, which gives you the best return on capital. It's kind of a gateway. Let's say bankrate.com. Today, bankrate.com will tell us which banks give you the best interest on your CDs. What if bankrate.com says, you give us your money, we will deposit it into the banks, which gives you the most yield, and you basically earn the returns. We'll take some small amount of our fees. So there was a company which became hugely popular, which is called Yearn Finance. And 3 weeks or 4 weeks ago, we talked about it, that their value of their one token on Yearn Finance was $40,000, because they provided a gateway to those investors, saying you don't have to worry about, you don't have to look into 10, 15 exchanges that are coming up. We will do the job for you. We'll pick up the best liquidity provider. We'll stake your assets over there. We become the gateway. And it exploded. More and more people started moving their assets from Coinbase, which was just lying in Coinbase. They said, why should I keep my, let's say, Bitcoin in Coinbase or Ethereum in Coinbase? It's not earning anything. I can move those from Coinbase, I can move it to Uniswap. It's still lying there, but it is at least earning me something. That is why Coinbase saw a lot of assets moving out from them into these decentralized exchanges. They got worried. The disruptors got disrupted, and now they started doing something to kind of fix that. So that's essentially is a concept of liquidity pools and yield farming. We will get deeper into what started happening, because now there are multiple exchanges coming in. Now they're fighting between each other to get more and more customers. And who wins in this battle are the people who are holding those coins and staking those coins. Because all these exchanges, they want, if they have to survive, they need to have liquidity. And now whoever is holding those tokens is like kind of a king. You want me to provide liquidity in your exchange? Okay, what's the deal? What am I getting? So they are incentivizing all those holders with multiple things to stake their coins. So interesting and very, I would say, anxious moments in this whole yield farming. So this is, I just introduced you to yield farming, but we will continue on it in the next session. So this finishes our today's discussion on decentralized finance world. Crazy stuff. Be very careful if you really want to play in this one. I'll just give you one example. The founder or the creator behind the Yearn Finance. Yearn Finance was the company that created the whole gateway for yield farming. So he started another project. Name is Andrew Cronier. And he's got a huge fan base because of the work that he has done on Yearn Finance. I don't even know where that Yearn Finance token is now. It was very, I would say, as everything in this decentralized world, things are very volatile. So let's see where that is. Oops, 1 second. Yield farming. So this is a new concept, and then the CoinMarketCap had to update their website to start talking about yield farming. Okay, so they list on all the liquidity pools. Let me just see, where's that YFI token? Oh, now it is 16,000. Things going $5,000-$10,000 in a day doesn't matter much in this world. Okay, so the founder behind this, he started another project for similar concept, but in a different industry. And then he tweeted saying, you know, he's got theory of testing in production. So he says, I'm putting the code out. I have not tested it. So don't go and start staking, your stuff in it. But because these get so much integrated with all other exchanges, you just can't really do a good amount of testing in your localized environment. So he says, I'm putting in a production. It is an untested. I will be testing it over next few weeks. Crazy stuff. People are so crazy. They still staked $15 million worth of assets into his project, into the smart contract. Overnight, of course, this was not tested. A hacker stole 15 million. He saw, out of that, and then returned 8 million back into the smart contract with a note. I'm sorry, but I need some money. So I'm returning some back to you, but I'll still keep the half of it. And there was a whole crazy story going around. Why did the creator even put it in production? And creator said, I clearly saying that it is not tested. I have yet to test it. But there are people like in fiat world, we have traders who will say, if you are buying it, I'm buying it too. If when a CNBC, Jim Cramer is behind something, I behind it too. So there are die-hard fans of that developer because he created Yearn Finance, had tremendous success through it. And those people, if Andrew is on this, I'm putting my money. So do your homework. All I want to say is do your homework before you put your money. This is crazy, crazy space. But be aware of it. These exchanges, some of these will survive, some of them may not survive. Maybe some new exchange will come in, but just be aware in terms of what's happening. Are these exchanges regulated and safe to invest? I don't think it is safe to invest. Just because I have not done study in terms to figure out, number one is, are those regulated ones? Do they have all the paperwork done with SEC to provide these services or not? And from a security perspective, I would say everything is secure until it gets hacked. Right? Someone asked me, do you think should I put money in Bank of America? Is it secure? Yeah, until it gets hacked. Equifax, TransUnion, they are all getting my personal information. They know more about me than my wife does or where I shop. Is it secure for them to keep this information? Yeah, until they get hacked. So I cannot answer on security, but on regulated, we really have to check. Because again, the regulations are very, let's say, not that crystal clear. When do you cross the line between, let's say, trading between an asset to it becoming a derivative of assets, right? So trading on Bitcoin, Ethereum, we have regulated exchanges, Coinbase, etc. Now these Uniswap, are they approved exchange with SEC? I don't know. So if you want to play in this, you have to do that homework. Hopefully, some of these exchanges would tell you upfront that if you are a US resident, sorry, you're not welcomed. But some of the exchanges may not do that. Or BitMEX never did that. BitMEX was selling derivatives, even though they were not registered with CFTC. So now, basically, CFTC is behind them, and now they have to fight it out in the court. Sumit asked a question, how much is a typical yield? It depends on the pool to pool, but I saw yield as close to, I think somewhere they were actually putting the yield. Okay, so yeah, it's here. A compound like has got DAI and USDC, the yield is 17% to 45% APY. So some of them mention the yield upfront. Curve mentions it upfront. So maybe in some other tokens, I was reading, in an article, the yield was as high as 600% APY. Again, which project was it? What tokens were it? Who knows? So, but if on curve, it does mention you upfront saying REN BTC and WBTC yield is very less, maybe 7% to 18%, which is less in this world. DAI USDC USDT yield is between 15 to 36%. Beats 10-year treasury. Yeah, that's for sure. But then you bear the risk. Treasury is the most trusted asset to stake your money. If you want to stake in here, you have to get these yields. Yeah, you have to take that risk. Now it's entirely up to you if you want to. Okay. All right, that finishes our discussion on the crypto world. Let's move back to fiat world. And like I said, we will talk about yield farming and the next topic, the next subject in this decentralized finance in our next session. I think that would conclude the discussion around decentralized finance. At least the thing that I am reading right now. Things could change the next week. Some new thing could come up. I mean, I read about NFT that wasn't even existing in July. But now I'm reading a lot more about NFT. I'm like, what the heck is this? What is the new thing? After yield farming, NFT is a new hot topic. Ramesh, I rather stay in option trading. Me too. I'm not doing anything in here. It is good to know about the thing. And so that we can make the right moves at the right time, we are prepared when those things become more commonplace. That's the whole objective of trying to understand this. All right, so let's do a quick, let me sip some water. But Ramesh, on option trading, you have to do the trades and do all the stuff there. You just move your tokens and that's it. But risk versus reward, the age-old game. All right, let's do a quick market wrap up for the fiat world. It's been a good week overall, especially if you look at, SPY up 3%, QQQ up 3%. The bonds, if markets are going high, bonds generally have a negative correlation. Even though we didn't see that in March, but at least there was bonds were a little weak. The best one was a small and medium business, IWM. It was up more than 5% this week. So overall, good week in the markets. I think this was the best week since somewhere in June. So after 2 or 3 months, the market was able to eke out a good performance based on tweet. Don't care what your technical or fundamental analysis is. Right now, only thing that market is running on is where's the stimulus? You talk about stimulus, that stimulus is coming, market goes up. You say stimulus, there are some hindrances to stimulus, market goes down. That's what essentially is happening, at least I'm witnessing. Year-to-date performance, QQQ is on the top. Oh, let me just increase the font so we can see it. Close to 32%. Gold, up almost 26%. Bonds is a third one, 17%. SPY is close to 7%. Dow Jones Index, because of the strength that we saw this week, it is in positive territory for the year. And IWM, it still need to catch up. It is still down almost 2% from start of the year. So almost all indices, the major indices are up for the year except IWM. still some catch up needs to be done here. Now, the reason I am bringing this up is if we are spending time in picking stocks, doing trades, and if our portfolio is mostly tech, then we should think if I just have QQQ, it's up 32%. Can we beat it? Does so when I look at it, that's how I look at it is if I'm invested 100% and my portfolio is mostly tech, then do I need to, you know, be so active and find trades and, do this company analysis if I cannot beat it? But so based on what your portfolio is, it will give you some idea of what if you just use those benchmark indices and save yourself some time. But if you are able to beat it, great. So IWM small business, they still need to catch up. And for the reasons we know, small businesses have been hurt the most because of this pandemic. So that index haven't even caught up yet. Otherwise, all other indices are in green for now. Let's look at the sector-wise performance. The best weekly performance was from materials, XLB, up almost 5% from where it was previous week. I think the again, no change from what we have seen it week over week. The energy and financials are the worst performing sectors of S&P. They are still, energy is still down 48% year to date. Financials still down 18% year to date. Though last week they did much better, financials and energy. But if you're looking at year to date, they still have to catch up with the rest of the sectors. And the reasons that we all know is energy, there's nothing much happening. No one is traveling, no fuel consumption. Factories are operating at less than their capacities, if they are operating. So, unless the economy reopens, unless we start to travel, we start to fly again throughout the world, there is an uphill road for energy. Financials, it's all the Fed game. Interest rate near zero. It's very difficult for these financial firms or banks to make money on net interest margin. That's all banks do. I mean, they basically earn money by borrowing it from a government at a lower rate and loaning it to people like you and me and the consumer loans at a higher rate. The difference is their money, is their profit. Now, if Fed has reduced the rate so low so that now you and I, we can borrow home loans at, less than 3%, how are they going to make money? Number two, a lot of people are scared that a lot of loans that they've already made to these companies and to individuals, they will all go bad loans. They may not be uh, able to recover those loans. So a lot of headwinds on the financial companies. Um, that's why they haven't been able to recover yet. Sector rotation from tech, Roths, that was true for, I would say, uh, last week, not the week that just went by. The tech has been really strong this week, because people probably there was some profit taking on the tech a week prior. And what this week tech has come back really strong. So we have to see on the financials and energy. Personally, financials has done wonderfully for me, and we will talk about it more in the trade section. Reason financials have done is because they haven't moved much, and I like those sectors or those tickers those which don't move much. So, any other feedback? Anything else you notice? Anything different? in markets. So I am positioned in financials, energy, uh, approximately. Mine is a diversified portfolio, so not just tech. Oh, in fact, I'm negative on tech. I'm in short on tech. Solar energy going up. Yes, solar energy, because of the poll results, solar is through the roof. Now, sometimes I feel that is bubble. That's too much, too soon, too quickly. Let's quickly look at, and I know I was chatting with one of our members, and we were looking at this Jinko Solar Holding Company. Look at the move. Like, they had only one red candle for last 20 days, from close to $20 all the way to $60 plus in 20 days. This is Jinko Solar, some Chinese company. But generally, solar, I think, because of the lead, and this is not a political discussion, but because of the lead that Democrats had seen in the polls, people are saying renewable energy is going to be the next one. So that's why we're seeing solar gone so high. So do you see risk in investing in solar now? Of course. Number one, that it's already moved up so high. Number two, it's just based on speculation that Democrat will be winning it. So I don't want to play based on who is going to be in the White House. We saw how badly it ended in 2016. So that's not a playbook that I want to play with. So I'm not doing anything on this. But if I had looked into a company and I know that it's a good company to invest in, only in that case, but not because market is thinking that Biden will be the new president, and then we'll have those Green Deal, etc. There's a lot of will be focused on a lot of renewable energy. If that happens, we'll have a lot more opportunity. We know. Roku, Netflix, TDD, all up. Yeah, all those tech stocks came back roaring. Roku has done really good. Even from us has done good. Trade Desk is up. Yeah. Any thoughts on new SPACs from Chamath? IPOB, IPOC, DEF. So Chamath is a very well known, and I can't say well respected because people have mixed feeling about Chamath, but it's a very well known name in SPAC. He's been kind of a veteran of SPAC. His first one was with the Virgin Galactic, through which he took Virgin Galactic public. Recently, he also did Open Door. Now he has come up with a few more SPACs. Again, as we talked about in a SPAC session, and maybe I should probably refresh that in some other ways. You really have to look into the SPAC and the structure of SPAC. Few things. Number one, who's a promoter? If you believe in Chamath, great. If you do not, stay away. Number two has it already identified a company, or right now it's just a blank check? They still need to go and figure it out. Number three, what's the structure? How much is when I say structure, means how many warrants, how many shares, etc. How is it being, the SPAC is being created? Because in many of the SPACs, those initial promoters, they get 20% of the shares. And then they also have a PIPE investment, which is called private investment in public equities, which will dilute the shares. There are so many complications in that. So understand that before you invest in SPAC. Chamath has got a good track record with Virgin Galactic. I don't know, Open Door has started trading yet or not, uh, but that's a Open Door who agreed to merge with Chamath's SPAC. So he's got a track record that he can talk about. And if you want to go ahead with him, uh, you can take, risk. But for for me, I would look at the promoter. I would look at how the structure is, and then I need to have a faith in that promoter for me to invest in a SPAC. Today, the SPAC has become a new hot thing. Many SPACs are coming onto market. Uh, Almost 50 billion or so is the valuation of the SPAC companies. The number of companies that have raised money through SPAC in first 6 months had already overtaken what all happened in 2019, etc. There were some stats, I can't recall all the stats, but those are the stats we talked about, that this space is becoming too hot. In some cases, I would say bubbly as well. Now, many of, I would say, ex-founders or entrepreneurs now suddenly waking up saying, I think I can create a SPAC and just raise money. It's so easy. And if I had found one company or maybe a CEO of another company, I got some good brand value, brand recognition, well, I'll go ahead and raise money through SPAC. Or we still think there will be bloodbath days before elections? Who knows? I don't want to predict where the market will or could go. Election, the volatility sector is already priced into market. It's not in November, but in December, because I think market already is kind of pricing in that it's not going to be an easy transition of power, or we may not even know who won it until in late November, etc. So we don't know. And Venu, I don't know, you mean bloodbath means will it go back to what we saw in March? Probably that won't happen. But could market correct? Or could the wall go high? That is possible. All right, so let's look into some of the other stuff if there are no further questions. SPAC Insider. Yes, I think, thank you, Ross, for sharing it. Yeah, they have got a lot of details around which are the new SPACs coming up. This is Chamath's Social Capital. Oh, he's got a lot more coming up. Yeah, there are many SPACs in the market. You really have to see who's the promoter, who are the people behind the SPAC. Do they have an experience in that related segment? There are some SPAC that don't specify anything. They're like, we'll raise money, we'll figure it out, which company to acquire. There are some SPAC which will tell you, we will focus on retail industry, we will focus on travel industry, we will focus on this particular industry. In those cases, you can also figure out who is behind the SPAC. Do they have a credibility in that industry or not to make those decisions? I am little bullish around the SPAC with the Pershing Square from Bill Ackman because I liked its structure. Again, Bill Ackman has got his own shares of wins and losses, but the way he structured the SPAC is more conducive or better for the investors who buy into the SPAC. So if I were to take a position, maybe I look into Pershing Square Taunton Holding. That's Bill Ackman's. And again, he had not specified what he wanted to do. Only thing he mentioned was they want to acquire a mature private company. It's a big SPAC, almost $4 billion with an additional three and a half. So it could be $7-8 billion. So the universe is very small. And what I read is he approached Airbnb and Stripe, and both of them said, no, not interested. So if you have faith in Bill Ackman and you think he can turn around, he can find a company to take public and will do a good job, you may want to pick up some position in his SPAC, which is Pershing Square Thornton Holdings. Cool. All right. Well, that's it on SPAC. Let's continue. Coming back to our fiat world, some things that caught my eye. Elephant woke up. IBM plans to spin off infrastructure services as a separate business. That's what reported by TechCrunch. IBM, as we all know, is a big company, IT company. It has become so big that left hand didn't know what the right hand was doing, and that has shown up in terms of their numbers, right? Their performance, IBM performance, have been, I would say, less than what we, as an investor, someone would want it to be. Shares haven't done much. Sales have been declining, or at the most, constant. So EPS has been going down, even though they have been buying back their shares. So really pathetic performance over a few years. My sympathy with you if you have been holding IBM shares, but maybe now there is some hope. The new CEO who took reins last year, not even I think 6 months ago, is now making some changes. Last year, it was early this year, Ken. So what IBM plans to do is to spin off its infrastructure service as a separate company. And then the rest of the company will focus on new opportunities in hybrid cloud applications, the hot area. Now, the unit which will focus on this, the remaining part, could be a lot more valuable as a standalone company than if they are merged along with the infrastructure management company, which today it is, right? So it's nothing, it's just, it's a very standard practice of unlocking of value in a company. If in a company you have two kind of businesses, one is doing really great and has a lot more growth potential, and investors are willing to pay a lot higher multiple for it, but it is a part of a bigger company in which there are other businesses which don't command similar multiples, the company will spin off those units. So what IBM will do is to spin off the infrastructure service into some other company, and they will focus on the cloud business. IBM is laser focused on $1 trillion hybrid cloud opportunity, said Arvind Krishna, the CEO. The NewCo will have ability to design, run modern infrastructure, which is the separate company, which is infrastructure company, and the rest of the IBM will focus on cloud platform. Remember, in 2019, IBM bought Red Hat for $34 billion. Now, looks like they want to make money out of that acquisition. Red Hat is in the space of virtualization, in the space of providing solutions which companies can use to build on their cloud platform, especially around hybrid cloud. And that's what IBM want to focus on. They want to basically, make use of the money that is spent on Red Hat, which now it's, I would say, an exciting time for those IBM shareholders who have seen those shares do nothing. Probably now they will get a much better valuation on IBM. Ramesh, Red Hat is helping to, yeah, that's essentially the play. They spend $34 billion, but if Red Hat still stays under the bigger IBM umbrella, wherein they have a lot of those legacy business, it just can't command the same amount of valuation. So IBM did the right thing, separate out the two businesses. Now, is it too late? We'll have to see. So they are focused on hybrid cloud. which I know Amazon, Microsoft, Google, they are all great in the public cloud. So hybrid cloud is kind of a mix in which you could have some of your infrastructure in your office, in your data center, some infrastructure in the AWS or in the real cloud. And then you run on applications across both. You can have a single pane window, which will give you the complete 360-degree view, irrespective of where you are hosting your services, whether it is on your data center, under your desk, or whether it is in Amazon's cloud. So that's all the concept of hybrid cloud. Today, all the companies are rushing to cloud, but there are some industries that will never go 100% to cloud. Uh, you know, say, for example, some of the defense, some of pharma companies, they may want to keep some of the proprietary information in an area which they have a complete control on. Means they will keep those stuff in their data centers. Rest of the data they could move it to cloud. So that's where the whole hybrid cloud plays into. Yeah, Google is still trying to catch up right now. The race is, if I look at it, Amazon number 1, Microsoft number 2. Microsoft did really good job in last 3 years. Google number 3, they got a new person to lead the cloud initiative. They got it from Oracle, George Kurian, who is now leading their Google Cloud. Now I think number 4 is Oracle. It sprung out of nowhere. Oracle is doing a lot of work in enhancing their OCI services, which is called Oracle Cloud Infrastructure. Now they got some good brand names to boast. Zoom runs on Oracle Cloud. Everyone knows Zoom across the world. They got what, 300 million customers? I mean, their numbers are just through the roof. And Zoom runs on Oracle Cloud. They had recently they had few more significant wins. 8x8, not a big one, but now TikTok. Once that deal is finalized, TikTok will run on Oracle Cloud. I can't think of a big consumer known number on IBM Cloud. Maybe if you know someone who's on IBM Cloud, big name, let's share. I don't know of anyone, at least from a consumer perspective. But Oracle has come up really strong. So I will put Oracle as number 4 behind Amazon, Microsoft, Google, Oracle. And then is there a space for a 5th player or not? We'll have to see. But that's a playbook on IBM. IBM woke up too late. I put IBM same category as Cisco and HP. That is true. Well, let's see if they can make out something of this or not. So because we're talking about IBM, let me also throw up another company, is Cloudera. So IBM wants to operate in this hybrid cloud opportunity. Cloudera had recently announced and Cloudera is coming from the legacy Hadoop on-prem data analytics. Now they are converging and changing into a cloud data analytics company, especially hybrid cloud. So a few months ago, Cloudera had announced that their hybrid cloud solution will run on Red Hat's OpenShift platform. So would IBM have to build everything? Who knows? Will it be better for them to just buy off Cloudera? There were rumors earlier, and I did see that when IBM jumped on this news, even Cloudera shares also jumped high. So I'm not forecasting anything, but there could be synergies, right? Why build everything from scratch? If someone has already built it, IBM Cloudera already have a relationship, just buy it out. Again, that's my bold prediction to read between the lines. If IBM has to become big on hybrid cloud, what other opportunities exist? Snowflake is not hybrid cloud, that's 100% cloud. Uh, but the Cloudera is hybrid cloud. Next one, AMD rumor to buy Xilinx. We talked about Xilinx when we were doing our 5G investment analysis, 5G investment thesis, that Xilinx is in FPGA, which could become a big business once 5G comes in. Looks like we were not the only one thinking about it. AMD is also thinking about it, and they want to buy Xilinx for close to $30 billion. The race has started in semiconductor industry. NVIDIA is buying ARM for 40 billion. AMD wants to buy Xilinx for $30 billion. So, and again, for all the reasons that we talked about earlier, is the role that Xilinx can play in 5G space. All right, so let's spend some 25 minutes on a benchmark report, and then we will jump on to the trades. So software is cloud. As we all know, anything in the software, if you have to get any valuation, it has to do something with the cloud. So Benchmark produces this report. Benchmark Capital, the vendor, the respected VC firm, they produce this report every year. I got a chance to read through the report, and I thought I'll share that with you. So top highlights. And again, these are all the private companies. Some of them have gone public. The reason now we can talk about private companies is now we know how to invest in private companies. We talked about it in one of the private sessions, in one of the Saturday sessions on if we are interested in a private companies, what are the avenues available to us? So if you like one of the companies that we're going to talk about in this, you may want to explore that. Or if you find that it's available on those avenues, you might want to take advantage. So let's look at what does Benchmark has to say about the top cloud 100 companies. The private valuation continues to get bigger. No surprise here. We have seen what happened to Snowflakes and any other companies that are in a cloud space. The threshold to make to cloud 100 continues to get higher. Obviously, because the valuations are going higher, the median cloud is unicorn. Unicorn term was coined a few years ago because unicorns are, you don't see it, right? But now the valuations are going through roof that more than half of the companies are already unicorn. The average valuation of the 90 to 100, the last 10% is above $1 billion, 87 unicorns. So unicorns are everywhere. Maybe we should give a different name to those companies who got more than $1 billion because those are not unicorns anymore. The most featured cloud software subsector was sales, marketing, customer experience. 19 companies are in that sector out of top 100. Data and infrastructure subsector is the most valuable, which is 52 billion is the value of the companies that operate in data and infrastructure space. Cloud companies continue to drive massive returns. I don't think any surprises over there. So let's look at the 5-year progression, how those companies have done. First 5 years of Cloud 100. And I think I will basically continue to follow this in 2021. I like the whole benchmark report. The top one in 2016 was Slack. 17, 18, 19, Stripe was the top company, number one company in their report as a part of a cloud company. 2020, it was Snowflake. Right? Cloud 100 2020's list represent $267 billion of equity value. Let's look at some quick highlights. There are 27 newcomers to this list, means companies that did not exist in the Cloud 100 list in 2019, but they exist in 2020. New norms, how the valuations are. The average cloud valuation was 25 times the annualized recurring revenue, equivalent to 25 times the sales, right, in the recent round of financing. Oh, that's the average one. So now if we are looking at a company and trying to see if it is fairly valued or not, if it is a cloud company, it's a pre-IPO valuation is almost 50 times, 25 times ARR. Companies like Zoom or Snowflake, probably in a public market, are way higher. But this gives us some idea of how these companies are being valued. The median is around 20x. So say around between 20 to 25x is the valuation of a company. The average cloud company valuation grew by $1 billion year over year. That's fine. Let's look at what happened to the lower companies, the companies at the bottom. Even the bottom companies, the average company is a unicorn. So even if we are bottom feeding in here, we are probably trying to invest or looking at a unicorn. Okay, let's look at their subsectors. In 2020, sales and marketing, customer experience, 19 companies are in this subsector. Data infrastructure, second bigger one, 17. Design, collaboration, productivity, 12. Companies like Asana come into this. Data infrastructure companies like Snowflake. Security, 10. So sales and marketing was the largest. Some names are Intercom, Pipedrive, Yotpo. Data infrastructure was number 2. For example, Snowflake. Now Snowflake is already public, so will not find a space in the report for next year. But this report was generated before Snowflake became public. HashiCorp, Databricks, Confluent, Rubrik. So it is very challenging to build these products in the space, but the market is so huge that if you're successful, the opportunities abound. So even though it's got only 17 companies, it's got almost 50% of the valuation is commanded by these 17 companies. Some examples over here: HashiCorp, Databricks, Confluent, Rubrik. The greatest growth in the number of companies is in design, collaboration, productivity. COVID. We're all sitting at home. How do we collaborate with our employees? How do we collaborate with our colleagues? We need those collaborative tools. Canva, Figma have seen tremendous growth in 2020. Okay. Valuation, we already talked about it. We touched upon valuation briefly. Of data infrastructure is 52 billion. Let's look at the exits. Means if you are buying in, or if you plan to buy into some of these companies from a private market, we want to buy it if I can exit it profitably. So let's look at the exit, how those exits have done. In 4 years, 57% of the companies that were in 2016, they have exited for $150 billion. So all the companies that were part of 2016 100 list, 57 of them have gone IPO. Average size is 2.6 billion. 2019, the companies that in 2019, 8 of them have gone IPO. In 2020, there have been 10 exits. JFrog was part of this. Snowflake was part of this. Encino was part of this. Plaid was sold to Visa. And then there are other couple of other companies that have already gone public, Asana and Sumo Logic. So I found this report really interesting. We know that cloud is a growth area. And if we have to wait like a snowflake, and then we can never get into the valuation that we want to. And now we also know how we can play in the private market. I thought this report is now useful, could now make sense for us, that if I am interested in buying some companies before they go IPO, maybe I have some names now that we can talk about. So the full report is available here. I just took out some of the extracts. So I'm putting it in the chat in case anyone is interested to read through the full report before they make a decision on invest or not. Okay. All right. The other thing which I found interesting was FOMO. We all have FOMO. Snowflake FOMO on the day of IPO, Nikola FOMO, probably that, if you didn't participate, you had a FOMO that turned out to be good. But all of us have some stocks that just went, ran away from us. And then we kept thinking about, I have to do it, I have to do it. Or there are some stock where we have invested just because we had a FOMO. Anything, if you have to share some of the stocks that gave FOMO to you in recent times, which one are those? Feel free to share if you want to. So, but if you have FOMO, you're not the only one. What I found in Benchmark's report is they share their own FOMO. And, it's okay to miss out. So don't give in to FOMO, because Benchmark had missed out on many companies and have still done wonderfully good. So Atlassian. So in 2006, they had opportunity to invest in Atlassian, and the valuation was $400 million. And they thought it's too high. Now it is $48 billion. So they had an opportunity invested at $400 million. They passed it away. So if you're getting into grip of FOMO, it's okay. Facebook. And what I liked about Facebook is when they met Eduardo Severin and his pitch, they told, kid, haven't you heard of Friendster? Move on, it's over. There is no future for Facebook. There's already a Friendster that exists in the world. So they gave up on Facebook. Now let's not talk about, hey, I missed on stock A or stock B. They missed on Facebook. They missed on Google. So David Cohen, his college friend, had rented the garage to Sergey and Larry. And David Cohen was in Benchmark. And he knew that if he goes to his friend's place, Google founders will pitch Google to him. So they asked, he basically asked his friend, how can I get out of this house without going anywhere near your garage? Because he's like, I don't think this company has any future. Tesla. He passed on Tesla 30 billion in market cap. And the mother of all misses is Apple. 60 million valuation. And they said it is outrageously expensive, right? Who wants Apple at 60 million? Too expensive. So the whole idea is, when I read through this, it made my life much easier. It made, the acceptance of the that the fact that I looked at Amazon at 600, 700. I'm like, too expensive. I didn't buy Amazon a few years ago. Now I think it's okay. We'll still do good, even if we have missed out on those. When I looked at all the misses that benchmark had. So even professionals do it. So it's okay. Don't beat yourself up if you haven't bought Mercado Libre or Amazon or Netflix when Netflix was at $60. We'll still do fine, still stay engaged. There are a lot many other opportunities that keep coming in the market. So the game is not over yet. So that's the interesting stuff I found. All right, let me sip some water. We will. Tesla is cheap now. From what? From 4 weeks ago? Probably. Uh, again, Tesla valuation is dependent on what you think Tesla is. Its valuation is not in terms of the car, but in terms of the data that it is gathering, in terms of the battery technology that it is building, and the fact that Elon Musk also have SpaceX. Can there be some synergies that he can drive? We cannot value Tesla based on what the automakers are doing. From that perspective, Tesla is outrageously expensive if I think Tesla as a car company. And again, this is my theory, right? Someone else may be thinking it in a different way. If I think Tesla as a car company, it is outrageously expensive. But if I think Tesla as a company that can provide autonomous software to the rest of the world, because they built it so well because they have a lot of data to build it. They have seen it in action more than anyone else in the world. And they also have access to great technology in battery and in SpaceX. And they can become a vendor for everyone else. In that case, Tesla may be undervalued today. Now, the whole idea is where do you lie on the spectrum will define what do you think the Tesla valuation is. After split, it is affordable to Robinhood. Okay, so I don't even look at the whether company is cheap or expensive based on what the share price is. Share price is immaterial to me because that can be gamed in a moment, right? You reverse split, your share price changes. And in the world of fractional shares, there is it's anyone can buy the any shares even if they have a small amount to invest. So I don't know, some people pay a lot of attention on where the share price is. For me, if I'm looking at a company, I look at what's their market valuation is, what's their overall market cap is, because that is something which a management cannot change by splitting the shares. So I was talking about Tesla from that perspective. All right, so let's jump on to one case study that I want to talk about, especially will be helpful for those who are new to options. And the case study that I want to talk about is the trade that we have talked about multiple times here. But today I'm happy to announce that I closed that trade this week. So case study is how we managed a losing trade and converted into a profitable one. Okay. Everyone able to see and can read it? Is this an eye test? So let me know, is it readable? Okay, eye chart for some. Okay, probably this is better. Hopefully. All right, so this is something that we talked about earlier on. Let me just bring that up. We started this trade in mid of July, first week of July. This is the trade on gold, ticker GLD. Stock was at $167.80. So I did a custom trade, which is sold a short put spread, 160, 165 put spread, and a short call at 175. Right? The reason I did a naked call was I hold gold in my retirement portfolio. I'm like, fine, I lose on this option trade. I'll gain on the retirement portfolio. So net, I'm okay. But by now, if you would have noticed, I don't want to just wait and take the loss. So if stock goes against us, I'll try to manage it. And that's exactly what happened. On 6th, I opened the trade, and let's see what happened to the stock or the gold near the July. Okay, so if we go to gold and during that time frame, I mean, we've been trading gold for months, but markets will do things when you least expect. I did gold here on 7th, and it made the moves that we haven't seen in 3 decades. Huge in silver as well as gold. So this position immediately went against us because gold made a huge move. So I started to get challenged on the call side. So what do we do when you get challenged on the call side? Come on, we talked about multiple times. On our trade management stuff is we roll up the put. The stock on 22 was at 174.49. It's already on my short strike. It's already here. So we rolled up the put from 160 to 167. So we rolled this put up from 160 to say 167. Stock continues to move higher. Stock is at 183, 728. I rolled it further, 167 to 173. On 8.4, stock continues to go high. I mean, if you really look at what the stock had done over that period of time, boom, straight up, all the way to 194. And when I hear it's like 186. So we were continuously being challenged, but we stick to our plan, is keep rolling the put up. So we roll the put again. This time we rolled it from 173 to 177. Gone inverted. This is our number 4, right? When if first is you add a put side, I already have a put side. Keep rolling it. Keep rolling it. Go inverted. So I went inverted by $2. Stock continuously stay against us. So what we do? We were in August, we rolled it out to September. Collected additional premium, $3.52. Then let's move further. We went in September. Did stock came back to cooperate? No way. No hell. I was at 177 here. Oh, this was 177. Stock continued to stay high. So I moved 177 to 180. Now remember, my call is at 175. So this was my call. Now I'm at 180, which is I'm $5 inverted. Stock didn't cooperate. Still far away. Rolled up again, 180 to 182. Now I am $7 inverted. So coming close to September expiration, stock has not cooperated. I am $7 inverted. Rolled out everything from September to October. So this is where I did a final rollout from September to October, got additional credit. So every time when we've been doing either the roll up of the put or rolling out the trade, we kept on collecting additional credits. 323 here, 51 cents here, 75 cents here. We look at the other ones, $33.52 here, 21 cents. These cents and the dollars, they match up. They add up. So by the time I was done with all these, overall, we collected $11.42 as a premium. And finally, stock cooperated. In this week, it came back between 182 and 175. That's our max profit zone, right? If we are inverted and between 175 and 182, I want stock to come between that. Stock came between it, I closed it. Didn't have to be too greedy. Whatever level I was able to close it, I'm like, it's okay. I was losing more than $400 right over here. And we managed it. We were able to exit with $266 of profit. That's what. It took some time, took some perseverance. We just have to stick to the rules. And even if stock had not cooperated, I would have lost less because I collected a lot more premium, right? If I had here, my premium was just $2.15. But by this time, I had a lot more premium. So that's another case study because we talked a lot about manage the trades, why it is important for us to manage it. Because you can convert your losers into winners if you manage it systematically. It took what, 2 months and maybe 7 trades. Stock is still not cooperating from my initial position, right? My initial position, my short call was at 175. When I close the trade, stock is still at 181. So stock hasn't yet fully cooperated, but because of these, I'm like, okay, I made profits, let's get out. And that is why I like about options is without any addition of capital, we were still able to convert this into a winning trade and then close it. So this trade is now off my radar. So Sumit says, I see sometimes want to adjust too many times. What if you had taken the loss and invested the time and effort on to the next trade? So you have to also find the next trade. Sumit, you have an equal amount of a time to time and effort you have to spend to figure out another trade. So from that perspective, I'm not added any more capital, right? I don't want to add more capital to a losing trade. So only thing I've done is to salvage what I can do from this trade. Any new capital has gone to other trades, right? So that's what I do. I won't add more capital to this trade, but whatever I can do to salvage the trade, I would do it. Sometimes, I may not be able to close it for profit. Well, that's okay. Then you don't win every trades. And so when I look at my statistics for this year by end of September, because of the managing of the trades, I'm able to increase my win rate by 8%. If I had not managed it, or if I manage it, the difference is almost between 8 to 10%. So, and increasing your win rate by that amount without adding additional capital, I would take it. So now talking about adjustments too many, that you have to think is, for example, in this case, I waited to do the adjustment, the first adjustment when the stock was right 175, right? because stock will continue to move. So you have to wait and see, is it a movement that is like in the normal course of the stock, or is it going too far away? And based on that, you have to decide when you have to make an adjustment. I mean, we talked about these in when we discuss the option adjustment techniques. When you ask similar question, is trade management means multiple time buy and sell same ticker? For tax reasons, each transaction is different. We pay fee for each transaction. So first of all, to fee is de minimis, right? 45 cents or 50 cents or 65 cents. So I don't think about a fee, because some part of a time it will become zero. So I want to build my I want to get into a habit of uh, earning. If I were to pay tax because I earned, it's fine. At least I made money. I don't want to get into a mode of let's take loss here so that I don't have to pay a tax. Right? I look at it from that perspective. So we made money on it. If I have to give some portion of that money to Uncle Sam, fine, I'll retain some portion of it. Yeah, again, don't try to overcomplicate this thing. I mean, we talked about all those adjustment techniques. Pick up the untested one, move those out. Again, don't do too many of it, because sometimes the stock will move on its normal course. But at least my experience is, if I manage it, then most of the time it will work out okay. There are some cases where it won't work out. You take a loss, or we take a loss, which anyway was a losing trade to begin with, because that's why I had to manage. But I will take a little less loss in that case. All right, so that's about the case study. Any other experiences to share you guys have in terms of managing the trades? I know this is not probably those who are just into options. It's a new topic for them. And if you are only buying options, unfortunately, there's nothing much management techniques exist if you have been only buying options. Because when I talk about management, I mean you manage a trade without adding any additional capital. When you want to add additional capital, all bets are off. Then why should I only focus on this ticker? It's a losing trade. Like Sumit said, maybe I want to pick up something else. I want to invest more money on some other ticker. But all this management is when you don't have to add additional capital. All right, yeah, Venu. Yeah. So Ramesh says, I prefer to be a seller, buy back only to manage. Exactly. Uh, if you are just buying it, there is nothing much you can do if the trade goes against you. We are just hoping that stock will cooperate, market will cooperate. But if we are selling, we can fight back, we can manage. We just saw GLD example. All right, let's get into the trades. XLU, the trades that I closed, XLU, we had in a short, it's we had an unbalanced, I would say, iron fly. We had a short put and a call spread. I had to do no management here. When we did it, the XLU was 59.82, came back close 61. We closed it. Nice little trade, no management, nothing else, got auto closed. Canopy growth that we've been talking about, again, when I opened the trade, it was a bullish trade on $15 short put. Stock was at 16.12. Stock did not cooperate, fell down. But this week, I was able to close it for 35 cents. Stayed in the trade for 26 days, a good return on investment. Similarly, the other trade that we had on Canopy growth, And I'm bullish on cannabis sector, especially on cannabis growth. So I had a couple of bullish trades. Again, in this case, this I closed it, I think on Friday or maybe on Thursday, because stock went really high. And it stock cooperated, and then I was able to retain handsome amount of premium. We sold it at $1.67, and I closed it at 50 cents. So overall, canopy growth, all the bullish trade worked out well for us, even though in one case the stock did not cooperate, in other case the stock did. But I'm still bullish on canopy growth, so I added another trade, so which we will talk about. GLD, that one trade that inverted strangle that we talked about, that's closed. I still have one more trade on a GLD, which also we were able to close at our profit target, which was an iron fly short put short call at 184, and then we have a long call and a long put at 200 and 168. Did not need any management. So we had two trades, both of them we were able to close profitably. This was the case study that we just went through. Finally, after 4 months, from July till October, or 3 months, we stayed in this trade, but eventually able to close it for a profit of 266. Not a huge one, but considering the fact that I was losing more than $400, I will take this at any day. So these are the trades that we talked about earlier and I had closed, but it means there are some other trades which I'm still holding. Silver, I did nothing to silver last week. I'm still holding, let's say, silver. It is still, I mean, it's making some money, but I'll still hold it and see what silver does. Silver is one which I think eventually, if I combine all the trades that I had already closed, and when I close all this, probably this is one where we will lose money. Again, we can't convert all of them into profitable trades, but right now we've gone these inverted, etc., just to make sure we can reduce the loss. A silver ran up too much, too high, just like gold, for us to do anything about it. So we may have to close it for a loss, but that's okay. The amount is not big for the account portfolio. Okay, do let me know if you have any other questions. Otherwise, I will continue on this one. Eventbrite, and we had a short call, covered call, because I own long shares. Nothing much. We're just able to close it. Oh, sorry. I'm still holding it. Eventbrite, I still have it. Let's look at Eventbrite. It's far away. I think this will just expire worthless. A 17.5 short call for October. I'll just let it expire worthless. This will help us reducing the cost basis of the shares that we own. DocuSign, we had made some decent money in DocuSign, and I continue to play DocuSign. Opened this trade on 23rd. I'm still holding it. It is making some decent money, but I'll still hold it, until my GTC order gets executed automatically. I don't know, maybe I've set it to get maybe around 60 or 65% of MATs. So it's making money, but we'll see. Maybe in this coming week, I'll close it. Same is the case with Lululemon. Played it multiple times earlier also. And even now it's doing good. Again, making close to 50%. This is probably a prime candidate for me to close this coming week. What else am I holding? PagerDuty. I'm holding a covered call on PagerDuty. I own stocks on PagerDuty, have 500 units. Sold a $30 call when the stock was trading at $26. I sold a $30 call. Now, after that, stock has moved up. So I sold it somewhere here, 923. And then the stock has gone up, which is okay. It's a good problem to have when a stock is challenging our covered call strike price, because overall my portfolio has gained. And my current cost basis of PagerDuty is near to $20. So if these shares get called at 30, fine, I made my 50%. If not, it reduces the cost basis further down, right? Nothing much to talk about. JP Morgan. Rinse and repeat on JP Morgan. People say financials are not doing anything. For me, financials are one of the best tickers, especially JP Morgan. This is our 10th trade in JP Morgan, 10th or ninth. And because financials have not done anything, JP Morgan has stayed this range bound all the way from mid of March all the way to mid of October. And we started doing our first trade somewhere here. Let's go back and see, right? JPM. Mid of March, 13th of March is when we started playing JP Morgan. And all of them have been profitable because stock hasn't done much. It has stayed range bound, and our trades have been range bound. So we'll rinse and repeat. Continue to play with JP Morgan. We'll close it when it hits 50%. I don't have any upside risk anyway. If it falls, I don't mind owning JP Morgan at $90. See, $90 JP Morgan means somewhere here at the height of pandemic. So that's why I love this trade on JP Morgan. We've done it 10 times, rinse and repeat on JP Morgan. We talked about Roku. Ramesh mentioned Roku is up, going up. Same as the case here. It is making some decent amount of money. I'll hold Roku because even if it blows through call spread, it'll make more than what it is right now making. And if it falls down, well, I'll acquire it at $165, which is okay. So I'll wait for it to make, it's making what, $760? Just 50%. Maybe I'll let it play for another week for theta to decay, and then we'll close it. For now, it's all good on Roku. I'm holding it. Eventbrite, trade number 2 on Eventbrite. We talked about October trade of the call, and then I also have a covered strangle. As you can see, I hold Eventbrite in my portfolio. For me, this is a economy reopening play, that if economy reopens, this company should do good. So I don't mind acquiring more at $8 if it falls down. So I did a covered strangle. Right now, it's well within our break even. We'll see how this moves in next 2 or 3 weeks. All right, so these were the trades that we have talked about earlier and the updated status on those. Now let's look at some of the new trades. Every week we talk about 3 new trades. And then we look at the status of what happened to those 3 trades. So new trades for this week, I want to bring up is XLU, rinse and repeat. XLU I want in my portfolio because it provides us with some diversification. For me, having a portfolio with the tickers which are uncorrelated is important, so that if one sector goes up or other goes down, I don't see too much volatility in my portfolio, and that's what I want to do. So I want to play XLU, not that I'm too bearish or bullish. So I did a slightly bearish trade, almost neutral to slightly bearish. It was trading at around 64. I did an iron butterfly, pretty standard iron butterfly. We did it on 9th. It's already making some money, but we'll hold it until it makes around 25 to 30%. The reason I did slightly bearish was look at what XLU has done in last uh, 10 days. So it doesn't mean I expect it to start falling. It might just consolidate, move here, etc. So that's why I went little bearish, thinking it might consolidate before it goes down. And if not stays here, probably the theta decay will be enough for us to take it off for profit. And canopy growth. I'll put my money where my mouth is. I've been talking about cannabis industry and I'm bullish on it. So rinse and repeat. We saw that we closed all the October positions on 15 short put and 17 and a half short put. I went ahead and did November positions. So November, October positions were closed. So we got two November positions, $15 short put and $17.5 short put. And we'll see how this performs. So $15 is already, we put it on 7th and it is already making some money, not where I want it to before I close it. $17.5 I opened on Friday, yesterday, and a little bit of money. So again, I don't mind getting assigned on CGC. We have taken enough premium on CGC this year. So it'll be okay if I get assigned. If not, rinse and repeat. I will continue to sell short put on CGC. I think that brings us yep, close to end of all the trades that I wanted to review with you guys. Any questions? Anyone into this trade, close date, etc., or any other feedback to share? Then I'll jump on to things that I have on my watch for next week. Oh, let me look at some question. Ramesh says, I've started moving my gain trade to next year. Not sure, Ramesh, what do you mean by gain trade? All right, so what am I watching? Neo. That I think it will continue to stay on my watch. I have positions in Neo. Both I have a long stock as well as I have option positions. I use options to continuously reduce the cost basis. So let's see how Neo performs. Overall, it's a bearish move for me. So I'll keep an eye on Neo. Other one is Nanox. Again, it's a, I think I talked about it earlier. It's a new company into imaging. It's a pre-product, pre-revenue company, just like Nikola. Just like Nikola, there is also a report that Nanox is fraud. But I have done my own study on Nanox, and I like the company, what they're planning to do, and I like the founder. So, and I also read through the short report thesis, but I am still hopeful and bullish on Nanox despite that short report. It is a risk because what if they don't get approval from FDA? In that case, this stock is not gonna go anywhere. It'll become probably worthless. But if it does get approval, this is a huge opportunity. So I like the risk and the reward. And my analysis says I want to be in it. And I'm okay to bear that risk that if it doesn't get approval, FDA approval. So I am in Nanox. It has seen some good moves in last 1 week or so, but this is my really, really long-term play. There's, I really like what this company is planning to do in medical field. Next one is Baba. I hold Baba in almost every portfolio: retirement, trading, long, options. Uh, the reason I want to keep an eye on Baba is because of the Ant Financial IPO that is coming up, and Baba has the most stake in Ant Financial. So that's, let's see if Baba can continue its upward movement because of Ant Financial or not. So it'll be an interesting play. GDXJ, we have a trade on GDXJ. Last 2 days movement in gold helped us in this GDXJ option trade. Not yet profitable, so I'll just keep an eye on GDXJ. Square, I want to keep an eye to figure out when does it correct so I can get back into Square. We had bullish positions in Square, which we sold off at our profit target. So right now, only thing I have in Square is long shares. I want to do an options. I'm still waiting to figure out. Right now, doing a bullish on Square, somehow I think it's too high, and I could be wrong. Maybe when it goes to 200, I might give in and saying maybe it's got a lot of tailwinds behind it. But I will watch Square, and if I see much weakness in Square, maybe I'll open a bullish position. Next one, Jumia, JMIA, not a ticker that we generally talk about it because this is not a US based company. This is a European based company and mostly active in Africa. So because I did not buy Amazon at 600, now I'm spreading my wings outside of US to figure out and find out what are the other companies who are doing similar work, which say Amazon has done in US. So in Latin America, I am invested into Mercado Libre. On Africa side, my play is Jumia Technologies. It is also called Amazon of Africa because this is the biggest e-commerce player in Africa. So when I say biggest e-commerce player, it is Africa. So the amount of merchandise that they sell is very less because e-commerce is not big in Africa. At some part of a time, this stock was almost $40. Short seller report came in, it fell down. COVID came in, it went up. Too high, too soon, probably. Again, it fell down. Now, again, it is going up. The thing that I like about this company is their strategy. There are operational challenges that they have to get through. In Africa, you don't even have a confirmed address. There is no standard way of how you write an address on a shipment. There are a lot more challenges. People are not okay to pay over internet. But what this company is doing, it's into e-commerce, it's into payment services, what Mercado Libre has done. So it's Amazon plus say Square. And this week, it moved into gaming because if you own your own payment services and you have your own gaming platform and you can basically in game purchases you can use your own payment services, that's great, which is what C Limited has done in Asia. So Jumia is picking up all the right elements from all the companies that have succeeded. From Amazon, it's picked up their e-commerce. From Mercado Libre, it picked up their payment services, integrate with them with their e-commerce. From C Limited, which is into all these things plus gaming, they picked up the gaming. So I'm bullish on Jumia from a strategy perspective. Operation challenges are still a lot of operational challenges, so they have to get through it. But again, this is my 10-year play. And because I've been selling options on this, my cost base is very, very less. It's maybe around $4 or something like that. So I will keep an eye on this one, what it does next week. And I still have some option positions in this. But this is my long-term play. Ramesh said, I switched to Meli after getting burned by Jumia. Yeah, I was saying Jumia was 40 and short seller report came in because, again, the reason short seller report came in is because they told that there were some inflated numbers from some of the partners of Jumia in Nigeria. And again, when we are talking about companies in uh, in third world or developing countries, some of these hiccups will be there. We saw what happened to Luckin Coffee. Right? But the same short seller, which is Citron Research, they actually tweeted on, I think, Friday or Saturday, when someone asked them, are you going to short Jumia? It says, no way. Caps, no way. Because they say we burnt our hands in going short on Shopify. So Citron also short its Shopify, saying that it's a fraud company. They have exaggerated their numbers. And because of that, I did not invest much in Shopify. I only picked handful of shares at valuation of $180. I'm like, too expensive. There's a short report. I want the shares to go down from 180. So then I will invest more. And it never went down. But I'm glad I didn't sell those handful of shares that I bought at 180. So nowadays, when I look at Ramesh, when I look at short reports, I want to dig deeper and read through the report and then come on to my own analysis of why this short seller is talking like this, and then see if it is really, because even they could miss. Citron had missed on Shopify. They were completely wrong on Shopify. And this week they told that they're not going to short Jumia because there's so many tailwinds behind it. And maybe that was one of the reasons, apart from this gaming stuff, that the share popped up. There was two tailwinds behind Jumia. So I'm still in Jumia. And again, it's not 20% of my portfolio. You really have to size it because operational risk is still there. But boy, if they can overcome operational risk, then they have whole of Africa at their disposal. Not 1 year, not 5 years, 10 years, 20 years play for me. So that's my thesis on Jumia. So again, Sumit, this is a company, it is called Amazon of Africa because its whole operations in Africa. This is a company out of Germany. And some of the African entrepreneurs actually take offense when people call Jumia as Amazon of Africa because it is not an African company. It's not an African jewel. It is a German-based company. Their founders are not Africans. So, they had a biggest operation in Nigeria. So Jumia might have all the subsidiary. They have a Jumia Nigeria, they have a Jumia Egypt. So it is possible that what you're looking at could be Jumia Nigeria. But the main company is in let's look at it right. It's a German company. Oops. So anyway, that's my thesis on Jumia. So I am bullish on this. So they have marketplace, they have a payment, they are into logistics, and now they are into gaming as well. The numbers are very less, right? They're into 11 countries. Again, I don't want to don't want to convert this session into a deep dive of Jumia. That's something we can do in some other session. But yeah, check it out. I think this is a German-based company, though they have their operations in lot many other companies across the world. So if you go to Nigeria, it will say you mean Nigeria. If you go to Egypt, that might have a different web. So Cloudflare is already kind of blocking me, saying, hey, you're going to a different company. Okay, I don't want to go through all this now. So Sumit, check on that one. What else am I watching? Let's get back to our Mercado Libre. I have option position in it. So I'm watching the JP Morgan. We just looked at JP Morgan. If it goes a little bit high or stay range bound, we should hit our profit target next week, and I will close it. Last is Bank of America. Again, I have positions in Bank of America, both stock and option position. So we'll keep an eye on that one. Both JP Morgan and Bank of America are reporting results next week. Earnings season is about to start. Financials are the first one to go. So we want to keep an eye on both JP Morgan and Bank of America on how they do, especially how much reserves have they built on to survive, all these loan defaults and all that stuff. So will be interesting to see that. Meantime, we'll continue to play JP Morgan as we have done over past few months. I think that's it on my radar. All right, so that brings us to the end of today's session. We can open it up for any general Q&A. Let me stop recording. Thank you everyone for staying along. And if you want to drop off, feel free. Or if you want to do have a general chit chat, that's fine as well.